Ever wondered how much your assets are worth in real terms? Or perhaps how much a business could be sold for if it continues to operate? These are just a few of the questions that financial terminologies like liquidation value, going concern value, and book value can answer. So buckle up as we simplify these terms for you. First up is liquidation value. Picture this. If you had to sell an asset or a group of assets separately from its operating organization, the amount you could potentially make is the liquidation value. It's the emergency exit value, so to speak. Now let's say you're not in a hurry. Instead, you're interested in selling a firm as a continuing operating business. The amount you could fetch in such a scenario is the going concern value. It's essentially the value of the business in its current operational state. Following this, we have book value. For an asset, it's the accounting value, which is the cost of the asset minus its accumulated depreciation. For a firm, it's total assets minus liabilities and preferred stock as listed on the balance sheet. Switching gears a little, we have market value. This is the price at which an asset trades in the market. It's the price tag the market puts on your asset. Intrinsic value, on the other hand, is the price a security ought to have, based on all factors bearing on valuation. It's like the fair price, considering all relevant factors. Moving on, we have bonds. These are long-term debt instruments issued by a corporation or government. Think of it as an IOU that pays you interest. The face value is the stated value of an asset. For a bond, it's usually $1,000. The coupon rate, meanwhile, is the stated rate of interest on a bond. It's calculated as the annual interest payment divided by the bond's face value. When it comes to stocks, there are two major types: common stock and preferred stock. Common stock represents the ultimate ownership and risk position in a corporation, while preferred stock promises a usually fixed dividend and has preference over common stock in the payment of dividends and claims on assets. The yield to maturity, or YTM, is the expected rate of return on a bond if bought at its current market price and held to maturity. Ever heard the term interpolate? It's used to estimate an unknown number that lies somewhere between two known numbers. Finally, we have bond discount and bond premium. The former is the amount by which the face value of a bond exceeds its current price, while the latter is the amount by which the current price of a bond exceeds its face value. And lastly, we have interest rate or yield risk. This is the variation in the market price of a security caused by changes in interest rates. In summary, financial terminologies like liquidation value, going concern value, book value, and others are essential tools in understanding the true worth of assets and businesses. They help in making informed financial decisions and give a clearer picture of the financial landscape, so the next time you come across these terms, you'll know exactly what they mean.